Hey there, fellow investors. Today we're diving into the exhilarating world of options trading. Get ready to explore a powerful strategy known as the Iron Condor. This strategy can help you profit in neutral markets. Whether you're a seasoned trader or just starting, understanding the Iron Condor can significantly enhance your trading arsenal. Options trading offers a unique and potentially lucrative approach to participating in the financial markets. It allows you to leverage your capital and potentially generate substantial returns. However, it's crucial to remember that options trading involves risks, and it's essential to approach it with knowledge and caution. In this comprehensive guide, we'll break down the Iron Condor strategy step by step. We'll cover everything from the basics of options to identifying suitable underlying assets, setting up the trade, managing risks, and more. So buckle up and get ready to master the Iron Condor strategy. Before we dive into the intricacies of the Iron Condor, let's establish a solid understanding of options. In essence, options are contracts that grant you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price known as the strike price, on or before a specific date, the expiration date. There are two primary types of options, calls and puts. A call option gives you the right to buy the underlying asset, while a put option gives you the right to sell it. When you buy an option, you pay a premium for this right. The value of an option is influenced by several factors, including the price of the underlying asset, the strike price, time until expiration, volatility, and interest rates. Understanding these factors is crucial for making informed trading decisions. Now that we've covered the basics of options, let's move on to the star of the show, the Iron Condor strategy. The Iron Condor is a neutral options trading strategy that aims to profit from a range-bound market. In simpler terms, it's a bet that the price of the underlying asset will stay within a certain range. This strategy involves simultaneously selling and buying four options with the same expiration date, but different strike prices. The Iron Condor is considered a limited risk, limited reward strategy. This means that your potential profit is capped, but so is your potential loss. This makes it an attractive option for traders who prefer a more conservative approach and want to minimize their risk exposure. To implement the Iron Condor strategy effectively, you need to identify a suitable underlying asset, select appropriate strike prices, choose an expiration date, and determine your risk tolerance. We'll delve into each of these steps in the following sections. Section 4. Setting up your Iron Condor, a step-by-step guide. Now let's break down the process of setting up an Iron Condor trade step by step. First, choose your underlying asset. The first step is to select an underlying asset that you believe will trade within a specific range. This could be a stock, index, commodity, or any other asset that offers options trading. Next, set up the Iron Condor. The Iron Condor involves selling or writing one out-of-the-money call option and one out-of-the-money put option. Simultaneously, you'll buy one further out-of-the-money call option and one further out-of-the-money put option. This creates a net credit in your trading account, which represents your maximum potential profit. Then, choose an expiration date. Select an expiration date that aligns with your market outlook. Remember, the more time until expiration, the higher the premium you'll receive for selling the options. However, longer expiration dates also come with higher potential risks. After that, calculate break-even points. Your break-even points are the prices at which your trade will start to lose money. These points are determined by the strike prices of the options you've selected and the net premium received. Finally, execute the trade. Once you've identified your underlying asset, set up the Iron Condor, chosen an expiration date, and calculated your break-even points, you're ready to execute the trade. Ensure you have sufficient funds in your trading account to cover potential losses. Section 5. Managing your risk adjustments and exit strategies. Risk management is crucial in any trading strategy, and the Iron Condor is no exception. While this strategy offers limited risk, it's essential to have a plan in place to protect your capital. One way to manage risk is by setting stop-loss orders. These orders automatically close your trade if the price of the underlying asset moves against you beyond a certain point. This can help limit your potential losses. Another important aspect of risk management is having an exit strategy. This outlines the conditions under which you'll exit the trade, whether it's to take profits or cut your losses. In some cases, adjustments to your iron condor position might be necessary. For example, if the price of the underlying asset moves significantly in one direction, you might need to adjust the strike prices of your options to avoid losses. Section 6. A real-world example, Iron Condor on the S&P 500. Let's illustrate the Iron Condor strategy with a real-world example. Suppose you believe that the S&P 500 index will trade within a range of 4,500 to 4,600 over the next month. To set up an Iron Condor, you could sell one S&P 500 call option with a strike price of 4,650 out of the money. Sell one S&P 500 put option with a strike price of 4,450 out of the money. Buy one S&P 500 call option with a strike price of 4,700 further out of the money. Buy one S&P 500 put option with a strike price of 4,400 further out of the money. By selling the closer out of the money options and buying the further out of the money options, you receive a net credit. This credit represents your maximum potential profit if the S&P 500 index remains within the 4,450 to 4,650 range at expiration. Your maximum loss is limited to the difference between the strike prices of the options you sold and the options you bought, minus the net credit received.